I will start with the trading obligation. The trading obligation for equities is quite straightforward. Everyone can understand exactly how it works, even if the thresholds are not defined yet. For the non-equity market, it's more complex because it's connected to the immediate clearing obligation as well. So to be subject to the trading obligation, you have to pass a number of tests. So for example, this means that the equity derivatives will not be part of the trading obligation in MiFID II. Secondly, big difference between how systematic internalizers is going to work. The systematic internalizers will be actually a part of the trading obligation for equities, whereas for derivatives it will be outside the trading obligation. And if you drill down even more in details, I think the SI quoting obligations will differ a lot. Then if you drill down regarding transparency, obviously there will be a lot of differences. One of the major differences is that for derivatives market and for non-equities, there will be a new trading venue type introduced, the OTF, and that will not be introduced for equities. I think so. I think the major reason is the fact that the CCP must accept to clear a financial instrument regardless where it's traded. And this in combination with we have the new OTF, the Organized Trading Facility. This means that in MiFID II, derivative can be traded on the regulated market, MTF or an OTF, and be cleared at the same CCP. And on top of that, we will probably see more systematic internalizers because of many investment firms will reach the thresholds. So I think there will be fragmentation in derivatives. How it's going to look like, it's too early to say, but it will probably look quite different from the equities market. But still, an investment firm need to take this into consideration when setting up your best execution policies and perhaps also consider to implement a smarter router for derivatives. Starting with the equities market, I think double volume caps is a source of big uncertainty. No one really knows how it's going to work in practice. Take for example when instrument is leaving the suspension period, no one knows what's going to happen then. And if you read the text, it's not clear how the larger scale trades are going to be handled, if they're going to be within the cap or not. Secondly, on the equities market, it's still a lot of uncertainty around the unbundling, the payment for research. How much of the old CSA model that can prevail in the new regulation. And last but not least, I think a big issue for the equities market is the rules for tick size for the systematic internalizers. ESMA has clearly stated that is outside the mandate to decide whether systematic internalizers should be complying to the tick size rules. And a yes or no in that question, on that question will have big implications for the market. For example, if the systematic internalizers does not need to adhere to the tick size rules, it means that the systematic internalizers can have tighter spreads than the trading venues. And that in combination with the best execution requirements will have big effects on the market. I think starting with the equity market, the double volume caps will have big effects on the market. The purpose of the double volume cap is to limit the dark pool trading. But the demand for trading in non-display liquidity will still need to find other ways. And we have already seen that today, where we have turquoise block discovery, we have BATS periodic auction. And we will probably see, going forward towards MiFID, we will see more innovation coming, even if there still remains a lot of uncertainty how the wave is going to work in practice. So everyone is eagerly waiting for ESMA's guidelines to get more guidance how this is going to work in practice.